Coming up on Market to Market. Rain makes grain, but only if you can get into the field to plant it. The nation's top farmer gets grilled on everything from lunch trays to food trade. And how one pork-producing family is cultivating fans in Japan. Those stories and market analysis with Don Roose next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. This is the Friday, May 19 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. As various investigations and the he said continues in Washington, rural Americans are dealing with more pressing issues like declining profits and new places to live. Commerce Department numbers show construction of homes fell 2.6% in April. And applications for building permits, an indicator of future activity, declined 2.5%. The downturn is being viewed by the National Association of Realtors as temporary. Despite the decay, the 10-state Creighton University Rural Main Street Index rose above growth neutral for the first time since July of 2015, buoyed by cautious optimism over farm commodity prices. One more sign of rural economic improvement was revealed as agricultural and construction equipment giant John Deere posted a second quarter net income of $802 million, nearly double last year. Farmers building on the future are attempting to finish spring planting. The weather has held the upper hand for most of the week and dealt heavy blows to more than one family. Paul Yeager has the details.
The number of working days for corn and soybean planting came to a screeching halt as another round of wild weather swept across the grain belt. A massive system extending from Texas to the Great Lakes left a trail of destruction. At least 40 twisters were reported along that swath this week. The hardest hit was Oklahoma, where a tornado killed one person. The devastation was widespread in this suburban area west of Oklahoma City. A twister ripped through northwest Wisconsin near Eau Claire on Tuesday, damaging this trailer park. At least one person died and 25 were injured. Another round on Thursday swept through Oklahoma, Kansas, and Texas, bringing destructive tornadoes and winds. Moisture is ample in the Corn Belt as the drought monitor remains at historic lows as corn and soybean planting keeps with the 5-year pace. For Market to Market, I'm Paul Yeager.
Facing threats of a 21% cut to his budget and a renegotiation of the North American Free Trade Agreement, the nation's top farmer and food program administrator, Sonny Perdue, was called before the House Agriculture Committee. Peter Tubbs took a closer look at the 3-hour meeting.
Agriculture Secretary Sonny Perdue returned to Capitol Hill this week with a downbeat outlook for the House Agriculture Committee.
Our farm economy is down about 50% drop in net income from where it was in 2013 as you all were looking and contemplating the 14 Farm Bill. We've got several members, particularly younger farmers, have levered up in this situation where the revenue is not supporting their debt structure, and they're in some dire straits that way.
Representatives questioned the Secretary about trade and the recently abandoned Trans-Pacific Partnership.
Many of the principles that you all had in that negotiations, I think are still viable. It's just a matter of fine-tuning those in a way that makes sense. That I don't think this administration is not against free trade at all. It really is more concerned of fair trade. You don't have trade unless it's fair for all those involved.
Right. Do you have any thoughts how we can make crop insurance better? As a policymaker, when I talk to non-farming public, when you talk crop insurance, the non-farming public can understand that better.
I agree with you that I think an insurance program for our producers is a much more palatable safety net program from the public shareholder perspective than direct payments were. We don't want to create a program where our producers are farming for the program.
Perdue emphasized the overhaul of USDA field staff would improve customer service.
When farmers and ranchers walk into those offices, I want to say, you know, whoever greets them, how can we help you today? That's not my job.
Rebuilding and modernizing river and waterway infrastructure has become a high priority for the administration.
I was at the White House yesterday over an infrastructure meeting, and let me tell you that inland waterways right at the top of their list.
And the Secretary addressed questions about the growing scarcity of farm labor.
It's not just an issue, it's an emergency. And I tell you, every single person that I speak to in agriculture, farmer to farm worker, they will tell you that the lack of labor force is the #1 most pressing issue that they're facing right now.
The good news is I think the President understands as well. This roundtable that we had, I think he understands the contribution that immigrant labor has made to our fields and farms and processing and other things. When I said a way forward, I don't know that I can elaborate on the path today. What we want to do is to give to my boss and administration an opportunity and to thread the needle over this issue of how we utilize immigrant labor in this nation.
From Market to Market, I'm Peter Tubbs.
Official numbers show U.S. pork producers sold a record amount of product to China in March. In the near future, cattle will rejoin hogs in the export stream traveling to the Asian giant. Opening doors to new markets can be the result of a chance meeting or pursuing a path others have long since abandoned. For two North Carolina brothers, it was a combination of both that started a profitable venture based on a single idea. Peter Tubbs has our cover story.
On a cool North Carolina morning, 184 hogs are slowly loaded onto a truck. A combination of unique breeding and specialized diet has earned their carcasses an 8,000-mile trip to Japan. But this export opportunity began 40 years ago with a humble spreadsheet.
We wrote software for indexing pigs. We would measure the economic traits like born alive, 21-day litter weight, growth rate. We would measure back fat.
The falling price of personal computers in the 1970s allowed the Ivies to analyze their data with greater precision and encourage them to experiment with genetics and feed composition. The results of their testing led to a 4-way cross hog that gained weight well while being calm in the hog house. The resulting meat stood out from other hogs being raised at the time.
You know, the industry was chasing lean, 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 no intermuscular fat. That product's very hard to cook and can be very tough.
The hogs were different. Their meat had marbling and a much higher fat content, which made the pork juicy on the plate. This marbling caught the attention of Japanese wholesaler Sumitomo, who was looking to import pork with some specific characteristics not normally seen coming out of U.S. hog houses.
They came into the plant and they saw the pork that were based on these genetics, the 4-way cross, and they basically said, that pork works for us. Started out with a tractor trailer load of hogs a week.
The Ivies now ship more than 12,000 metric tons of pork to Japan annually. The partnership with Sumitomo came just after the Ivies had begun working with the Maxwell family to grow their hog operation. The Maxwells, the nation's largest turkey processor, had excess capacity at their Goldsboro, North Carolina feed mill, and together with the Ivies grew a hog operation to over 70,000 breeding sows. Sumitomo branded the Ivies pork as Silky pork.
In Japan, the domestic pork is kind of the gold standard. And so we have the reputation of being not a commodity pork, but a special dining experience that competes well with their domestic products. So we're very proud of that.
The Japanese consumer is much more discerning than the American customer. While American households spend around 10% of their income on food, Japanese consumers spend more than 30%. The higher cash outlay is driven by a quest for quality and knowing as much as possible about the source of their food. The pursuit of the highest quality product remains part of the Ivy's business mix. The pair owns their own feed lab, which monitors the 750 semi-loads of inputs and mixed feed that pass through the plant each week. To guard against disease, every truck is washed before it travels to a farm using 2 different truck washes. At the plants where Silky pork is processed, like this one in Rantoul, Illinois, Sumitomo places its own inspectors to help ensure the pork is being cut in the way Japanese consumers prefer. Yoki Miyawaki visits all the plants that process Silky pork.
Japanese consumer wants to have super safe products. Whatever it is, they want to make sure that it was produced under a safe production procedure, and also wants to purchase stuff that is traceable.
Although pork is a traditional protein source in Japan, it has been secondary to seafood. The westernization of the Japanese diet has included an increase in red meat consumption, especially among younger consumers. Learning the unique demands of the Japanese consumer has been one of the leading challenges for the Ivies.
And they've really taught us a lot on how to make food better and safer and taste good. So they've been a great customer, and it's been a good learning experience, because we think that the same thing is happening now in the United States.
We believe that the American consumer is adapting to the Japanese model. There are more and more people that want to know the story behind their food production.
Rantoul Foods, which handles the majority of the Ivy's Silky pork, is a unique part of the supply chain. The owners strive for accuracy and quality over volume. The line moves at a much slower speed than conventional pork plants, allowing meat cutters to make more precise cuts and ensure the product always matches Sumitomo specifications. Each package is sealed individually, dunked in a cooling tank to remove any surplus heat, and inspected before boxing. The pork will remain at 34 degrees for the entire 17-day trip to Japan, delivered fresh to Sumitomo for slicing and delivery to retailers. One cut that is produced at Rantoul is the single-ribbed belly. American processors usually cure it for bacon. However, the Japanese consumer slices the belly for cooking. At plants like Rantoul, the spare ribs are pulled out individually, leaving the rib meat attached to the belly. The cut earns a premium in Japan and justifies the labor-intensive prep. The Ivy's data and focus on quality has given Japanese retailers the confidence to market Silky pork next to domestic pork successfully. And the brothers have plans to expand their reach by looking for markets closer to home.
We think we've done that in Japan, and we would love to do that here in the States. American consumer deserves it. I don't think they've gotten it yet.
From Market to Market, I'm Peter Tubbs.
Next, the Market to Market Report.
Political turmoil caused more volatility in the grain markets this week than weather or export numbers. The Brazilian real plunged in early sessions when President Michel Temer was accused of encouraging bribes. The fall dunked the market. July wheat rose 2 cents, and the nearby corn contract recovered enough to gain a penny. The falling currency pushed the nearby soybean contract through a 30-cent swing to finish a dime lower. July meal declined $6.30 per ton. In the softs, July cotton fell $2.73 per hundredweight. Over in the dairy parlor, June Class 3 milk futures added 7 cents. In the livestock sector, the June cattle contract dropped $1.73 and nearby feeders lost $1.38. The July lean hog contract continued to gain ground, moving $1.58 higher. In the currency markets, the U.S. dollar index plunged 210 basis points. Crude oil pumped up $2.50 per barrel. COMEX gold poured on $25.90 per ounce, and the Goldman Sachs Commodity Index improved nearly 12 basis points to finish the week at $391.40. Here now to lend us his insight on these and other trends is one of our regular market analysts, Don Roose. Don, welcome back.
Thank you, Mike.
Before we get started, You can listen to our market discussion anytime by downloading our market analysis and Market Plus podcasts on our website, iptv.org/MTOM. Don, crazy week in the market, specifically starting on Wednesday when these corruption charges in Brazil surfaced and we saw the Brazilian currency really fall out of bed. Hit the soybean market hard. I want to ask you, has it stabilized?
Well, you know, I think the good thing when you see this news like this is surprise news. It was a negative news. And really what happened when the currency fell 8%, their stock market fell 10 to 15%. What happened is you saw the Brazil prices become very competitive. The inflation pushed up the soybeans in their country, and consequently you saw the Brazilian farmer have the largest one-day sale of products, soybeans, corn, in the last few years. So that's really what pushed us down just very quickly. But when you see news like that, really it's one of those that you really see where the dirty laundry is and what prices are really worth. And I think the thing we learned about that is the fact that the wheat market probably is the best of the worst out there. Wheat, while soybeans went down 30 cents, corn went down 7 cents on that day, the wheat market actually found some strength. So yeah. I think that's what we learned from the Brazilian situation, which looks like it's going to be a long, protracted situation.
All right, well, now let's focus on wheat a little bit more. You did mention we saw some strength. We did see a 2.5 cent rise on the week in the nearby contract, which is better than the alternative. Have we put a bottom in this wheat market?
Well, the one thing we have about the wheat market is it's been in this trading range 420 to about 440, just really stuck. We popped up on the freeze weather that we had, and then the snowpack problem popped up to the 460 area. But I think what we've run into now is we're starting to really see once what the crop is like here in the U.S. We started harvest in Texas. The yields down there are a bit disappointing. The quality is disappointing. We have too much rain in some of these areas, so it's a real quality issue. We did have a good technical buy signal on Friday. Our trends turned up, so we'll see. Funds are sitting here with just this massive short position, and it's just a matter if we can spook them going into the harvest. And probably what's going to happen is the quality turns out poor and the yields less than we think. But the big competition is in Black Sea area in Europe. They raise 50% of the wheat, so they receive some rain there this week, so they're okay so far.
Okay, all right. Well, now the corn market. Let's take a look at that. As we look at Brazil, we've been hearing for months about this massive second corn crop, the safrinha corn coming out of Brazil. Dropped 7 cents on the news. Is there more weakness ahead, particularly in old crop corn, as they get that second crop harvested?
Well, the corn is the issue because the producer here in the U.S. is sitting on big supplies. South America has a big crop coming at us, no doubt about it. Argentina is about 33% harvested on corn. They're going to be competing with us. We're starting early harvest in northern Brazil. We're pollinating the second crop down south, so they're going to have a big crop. Argentina and Brazil export more corn in the world than the United States, so it's a lot of competition. So the seasonals are up on corn until June 9th. And then you have to be very careful from a producer standpoint because from June 11th all the way into harvest, seasonally we drop. So it looks like the window and the noose is getting tighter if you need to market grain.
On the new crop side of things, we closed the week over 390. Is this a point you want to start putting some sales in place?
Well, the good news that we, at least for us, we did have our trends turned up on Friday. We did get a buy signal on corn, so we'll see if we can. Funds are sitting 200,000 plus short on corn. We'll see if we can get a spook to the upside right here. I mean, the crop conditions, Mike, are really suspect. I mean, it looks like right now to come up with a trend yield is about what you're looking for. To have above trend, it looks like it's going to be more difficult. I mean, look at Illinois, one of the big two corn states, 42% good to excellent rating, 69% a year ago. That's one of the worst in the last 10 years. That is the worst in the last 10 years. We've only had 3 that have been worse since 1986. So I would say right now, let's give it a little chance to see if we can put some risk premium back into this market. Particularly, we got hit with the negative news on Brazil. Then we had a fairly good technical signal to the upside on Friday. Now we'll see if we can follow through with that to the upside. But
maybe we can spook those funds into covering some shorts and buying some positions.
I think that's it. It's, you know, but you have the U.S. producer, just a big, a lot of cash corn out here. Not sure what to do with it. The South America is the same way. Argentina's corn's much cheaper than we are, so it might be a fast move to the upside and back down. So I think a person has to be pretty much prepared. But it's the wrong time of year still to be negative, but the window is starting to shrink.
All right, keep your finger on the button.
I think you have to do this. That's right, and keep your eye on the sky.
All right, yes. So now I want to circle us back to Brazil. We've got a question here from one of our followers on Twitter. This is from Timmy in western Minnesota, and we encourage all of you to submit your questions on Twitter or Facebook. Timmy wants to know, how can the Brazilian real affect exports to support a summer rally? How much is this drop in the real's value going to hinder our ability to continue these great export paces we've seen in corn and beans?
Well, and that's a good question, and it is an issue, because you think about it. On Thursday, the Brazil real, their currency, dropped 8%. That means that they're 8% more competitive, 8% cheaper in one day than we are. That's like taking our dollar from 98 down to 91%. So they become competitive real fast in the world market, and you could see it. They sold more grain in one day than they have in the last number of years for one day. So they were sitting just like our U.S. producer. They were waiting for some opportunity to sell, and when they had the opportunity, they sold.
All right. So now with the soybeans, after this drop, we did have a nice close on Friday, had a nice relative. It was a bounce, what, 9-10 cents on the nearby, 7 cents, I believe, on the November contract. Are we through the worst of it? Was that panic selling, and now we can, again, find some value in this bean market?
Well, I think it was panic selling. It was probably opportune selling by the South American producer. It was probably technical selling in the U.S. market. But, you know, the upside of all the grains looks like it's more limited on soybeans than corn or wheat. So it still is very hard to get over $9.80 to $10 without something serious. But remember, we have a chance for weather concerns all the way into August on soybeans, where corn it's much shorter.
So should growers be locking in some physical cash sales right now on new crop beans?
Well, you know, seasonals are positive until middle of July, where corn is just the middle, you know, the 9th of June. You know, I think you have to be negative on the soybeans. I think if you look at what the government put out, is next year in 2018, 17, 18 is going to look very much like this year. $9.30 as an average price. Last year in 17, $9.55. So I think you still have to give the soybeans a chance to go down into that $8 to $8.50 range. Okay. The upside, $10, you know, is a tough marker. Maybe you can get up to $10.20, but you're certainly looking for opportunities to sell do some risk management.
All right. Now let's talk about the livestock market. First question to you, Don. We've seen a couple weeks now trending lower in the live cattle market. Can we say the top is in on live cattle today?
Well, we think that we put in the blow-off top on the cattle in the futures market and the cash market, and we're coming down right now. Of course, a bit of a surprise. The packer really got caught short bought, you know, for various reasons. Some of it the Brazil situation, again, back from the meat packing scandal. Some of it from retail demand, better than thought. Some of it from export demand, better than we thought. But yeah, you know, we think we put the top in. We expect it's going to be led by the box beef. We expect the box beef next week could drop, you know, sharply in the next 2 weeks. That should lead the cash market down, and that should probably put the basis levels back in line, which have been out of line in the futures market here for a number of weeks.
So how should producers be hedging against this drop, really just on the basis side?
Well, you know, I think when you have a basis like this, your best opportunity is probably to use the option strategies, put some window contracts on, and of course, you know, this is what the producer has been doing. He's been trying to market as aggressively as you can, pull cattle ahead, try and catch the basis when it's in your favor, like it's been dramatically. So that's what they've been doing a good job of, and I would continue. I would encourage people to continue to do that, because we're going to have big supplies all through the summer, 5% over a year ago, before we drop to 1% over a year ago in the fourth quarter, and then down 1% in the first quarter of 18.
All right, feeder cattle. Exciting close to the week on Friday. Nice little pop to the upside. Top in the same on feeder cattle?
Yeah, we think we put the blow off top to the upside there. Of course, you know, a lot of the feeder cattle during the summer is going to be dependent on what happens with the corn market, the feed input costs. So, you know, watch the corn. If the corn rallies sharply, it's not going to be a positive for feeders. But, you know, I would watch that. But we think that you were definitely at risk management opportunities when you're between 150 and 160 on feeder cattle. Downside, you know, could still be in the 120s, 130s. You know, it's still a situation where the cattle market overall isn't that bullish. It's just that maybe the bearishness over the last few years is behind us.
Okay, all right, progress from a producer's perspective.
Exactly.
Now, let's take a look at the lean hog market. We broke $80 on the nearby. What does that say to you from a technical perspective, Don? Are we on to a new horizon here?
Well, what we really did is we had a seasonal rally.
Okay.
We're back up, hit up to $80 mark on the summer months, close to contract highs. But those were opportunities and those were objectives that, you know, at least we had for a long time. So we reached some of the objectives, and now we're going to have big supplies of hogs in the second quarter, 4.95% over a year ago. That's going to stay with us all through the rest of the year. So when you really look at it as we march along through time, you know, do the summer months drop a lot? You know, they may hold in this area 78, 80, 76, 80. But it's the fourth quarter that we think has the biggest downside risk. December hogs up around 62. Remember a year ago we were trying to tackle 42 to the downside. So it's that's a concerning situation, we think, and into the first quarter. So we think we're at risk management opportunities.
And would you be using options at even that far out into December for the lean hog contract, or would you be just selling futures outright?
Well, sometimes the reason you don't sell futures is because it's not at a profitable zone for you. So we like the window contracts if that doesn't work.
All right. Well, Don Roose, thank you so much for taking the time to join us this week.
Thank you.
That wraps up the broadcast portion of Market to Market. However, Don and I will keep the conversation going, including answering more of your questions during Market Plus, available in podcast and video form on our website. And do you have thoughts about or suggestions for the program? Send us an old-fashioned email to markettomarket@iptv.org. And join us again next week when we explore a taste of Cuba in the Midwest. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.